This conference will now be recorded.
Good evening, ladies and gentlemen. This is Crusade Trading Frank. It's approximately 8:37 p.m. Monday, 8:37 p.m. on May 13, 2019. This is I would consider it to be quite an important and critical market update strategic webinar. Session will be recorded, uploaded to the Google YouTube channel for viewing by all other members or anyone out there with the internet connection to view. Full disclosure, this is purely for financial education and not for any solicitation or advice. On that note, let me begin. Let me try to keep, there's a lot of stuff to talk about, but let me try to keep it directly straight to the more important critical aspects of what's happening in the markets and show it through the technical charts and not get into a long-winded explanation of every little facet of the US-China trade war and such. But I will point out some very important things. That also an important piece of news from the US Trade Representative's office, the USTR office, that broke after the market closed, which was expected. Okay, so let me kick off by showing you how dramatically volatile these markets are. Not the first time we have seen anything like this. You know, we have gone through some heavy duty volatility periods in 2018 and now in 2019. So it's not shocking or surprising, but every time it happens, it feels shocking and surprising. You know, it's just the way it is. That's human nature. So saying all that, I'm going to go backwards here, meaning that I'm going to start off with showing you the New York Mcclellan oscillator. And one of the things that which all of you need to, as traders, trading in the real markets, not in the fictitious markets out there. Let me show you how dramatic that these markets can be, and dramatic primarily because they are held hostage to comments from President Trump. They're held hostage to the reaction and the retaliation by the Chinese government. So technicals can show you a specific roadmap, but be prepared for those technicals on a dime, like it happened today. Started happening, last night, with futures plummeting as the Chinese retaliated. First, they started to, obviously they're going to stand up to or speak up for themselves. And then President Trump went, just like any other schoolyard fight, right? He went and hit him hard again through the tweets, but beaten them badly and stuff. And the expected retaliation came from the Chinese, as in another 60 billion or so worth of goods that they put tariffs on, which was expected. And keep in mind, in the broader scope of things, that's not a really huge amount. And secondly, they held back on certain aspects of the tariffs, which kind of left the window for these things to be worked out by late June, and I would say, yeah, by late June, when President Trump has said that he would meet Premier Xi at the G20 summit. I believe that's on June 28th to 30th. So saying all that, these tariffs are not going to be implemented till the first part of June, both the US ones and the Chinese ones. So keep in mind that there is still room for maneuver. That's what hardcore negotiations are all about. But I wanted to show you was this. So here we are on Friday, where the markets rallied. I mean, absolutely picture perfect, extremely powerful reflex rally. We took full advantage of it, left some open positions going into the weekend, expecting that follow through to happen. But of course came the blast, and then the markets at one point today were down close to 800 points, 700 and change points, and we closed down about 600 points. So from a technical standpoint, this was a picture perfect situation where the markets basically went from a oscillator, New York Stock Exchange oscillator, as I've explained in my previous videos. Follow me for a quick Follow me for a minute on this. So generally the oscillator gets to about 66, as I explained, gets to about 50 to minus 52. You start to see a double bottom formation on the full stochastics. Nothing really to explain here. This is a pretty clear-cut V happening. That's all good stuff. And the oscillators jumped up about 20 points, all positive. Look at that. Okay. Generally speaking, when this happens, the market basically has a 2 to 3 day type of rally. So everything picture perfect on the New York Stock Exchange Mcclellan oscillator, from deep oversold, starting to jump up, still minus 33 with room to move up towards where it becomes flat or zero, and then to move up as the markets would continue. But this is the detour that the markets took. So here is the interesting part. So the detour was that we were at minus 33 oscillator on Friday at the close, things looking great. Markets went up, went down from being down, what, 500 points, 450 points to being up. I can't even remember because it's such a powerful rally, to being up about 200 points. It's really, really powerful. Multiple reversal winners. Not everything green, but massive reversal winners that were alerted, and just a solid day through and through to finish the week. So then what happens today? The oscillator slips down from the minus 33 level and now is minus 65. However, and this is what we call a positive divergence. It can be positive divergence can appear on any asset class, whether it be the VIX that I've showed as a negative divergence, whether it be in the S&P 500, which I showed last week as a positive divergence. It can happen in a stock as a positive divergence. And positive divergence simply is when the price moves in one way. In this particular case, the price of the value of the New York oscillator went from minus 33 to minus 66, rounding off the numbers. Yet, when you look at the internals barely budged. This is today's fully updated Mcclellan oscillator. So without really, going on and on explaining some of the most simplest stuff about it, just look at it. There is very little difference. There is very little difference in the underlying indicator, which is the full stochastics. You can see that. The crossover is still intact, yet the oscillator took a nosedive from minus 33 to minus 65. That is known as a positive, abbreviation for positive, as you all know, divergence. These positive divergences generally play out in about 24 to 48 hours, and they're pretty powerful. So barring another black swan event overnight, which I don't know how many black swans the market can deliver, okay? One was last Sunday, not this Sunday, Mother's Day, but last Sunday's 2 p.m. tweet that appeared from nowhere when President Trump basically just tweeted out that he's going to slap, what is it, the tariffs on $200 billion worth of goods from 10% to 25%, which really shook the entire financial and economic universe, okay? And the Chinese had reneged on a whole bunch of stuff. Chinese denied that, but hey, that's the way the game's played, I guess. So barring any real black swan type of events, this type of divergence plays out pretty strongly over the next 24 to 48 hours. So do not be surprised. Do not be surprised if we get a 2 to 400 plus, or if not more, type of rally that develops. We shall see. But this is the positive development that happened today. That oscillators fell hard, yet the internals, the full stochastics, remain intact. In the crossover. In fact, it did crossover, and you can see here, if you're looking at a large screen, you can see that it crossed over and it stayed there. And here it was just about to cross over. This was Friday at the close. Okay, enough said on that, and let's move on. So there's a whole lot of charts to show, but why repeat the same thing when I've already shown all those with comments on my real-time Twitter feed. So spend a couple of minutes looking through it. Here is your swing 533 chart that I also show. This updates throughout the day, and this is where we are. We had a crossover. It's that little move down here on the stochastics. Still showing a crossover, yet we had the MACD plummet hard because of the big drawdown across the board. We had a 9-to-1 down day. That's 90% down days are unusual, but happens during extreme panic like today. And that is when 9 stocks are down for every stock up. I think all 10 stocks were down if you really think about it. We did have some, very few, which were green. At certain points of the day. And but generally speaking, it was a 9-to-1 down day, and a 90% ratio downside is considered to be a flush out. So that's being shown in the MACD here. Yet the full stochastics still is maintaining a crossover, and generally when it maintains a crossover, again, I repeat, with the RSI at -10, this is the relative strength index. You can see that. Look at the shaded areas, and every time it's come down here, it has rebounded back. Now, sometimes it happens within 24 to 48 hours. Sometimes it happens within, well, generally within 24 hours. Sometimes it takes 48 hours. So I do not think it's going to take 48 hours unless we get some more tweets from President Trump, really smashing the Chinese, or the Chinese retaliating more by saying there's a nervousness in the market that they're going to stop buying government bonds. Keep in mind that the Chinese, with all the dollars that they make by manufacturing American goods there and then shipping them to the U.S., they put a significant amount of that money, and have been for decades, into the U.S. government bond market, and thereby stabilizing our appetite, or what should I say, funding our appetite for huge deficits, which all U.S. governments have had kept. Big deficits, big debts. Even President Trump, because of the large amount of spending and tax cuts, we have a huge, huge deficit. The national debt's growing, using his own words, bigly, okay, and in a big way. But as long as the U.S. economy keeps on growing, we can keep on funding the debt. So saying all that, some of the things that you guys might not know about, or many people out there don't know about, that the Chinese are huge buyers of our U.S. government debt. So there is a big debt auction coming up tomorrow, as they do the weekly options on the 30-year bond, primarily, and a 10-year bond, treasury bond, and there is fear that the Chinese might sit back a bit. They're not selling our debt in the open market because they need to buy debt in order to keep their currency within a range, buying U.S. dollars. I mean, so the currency within a range. But what if the Chinese decide that they're going to stop buying our debt? I don't think that's going to happen. That's the point where the Chinese yuan is going to depreciate substantially, and the rich Chinese, and there's a lot of them, fastest amount of billionaires, produced, or were being produced in the nation of China. They are going to start repatriating their monies outside China, which they already have. That's why most of New York is owned by presidential properties, including a lot of Trump properties are owned by Chinese billionaires. There's nothing wrong with that. And in Canada, they literally own most of the properties there. So go to Vancouver, go to Toronto, you'll see that. So they'll repatriate their money real fast. So that's not going to help China much. So I don't think they're going to mess around with not buying our U.S. debt as they've been regularly doing. So anyway, so saying all that without getting into too much, we will see how that auction goes tomorrow, and you're going to hear about that for sure. And let's dive into technicals. All right. So now you guys are reasonably well informed, and let's move on. One other important thing is the USTR disclosed all the new tariffs that are on the $300 billion $300 billion worth of Chinese exports that they're going to put on. These are not getting put on right away. As you know, this is the proposed tariffs. It's a long-winded logistical legal process where companies can apply to get exemptions. And the good news is that Apple watches and Apple headphones and all that stuff that are manufactured in China and Apple stuff primarily are excluded from it. So that's good news. Okay. But there's a whole list of them. And if the $300 billion worth of tariffs do go into effect, as President Trump has wisely decided that he's still thinking about whether or not he's going to raise tariffs on that, which is a smart negotiating ploy, it might not even be implemented. So those were released after 6 p.m. So there was nothing surprising in there. So let's get into the nitty gritty of it. Here's a picture of your S&P 500. This is live. Futures are up roughly about 5 points right now. Let me put this in yellow. There you go. Futures are up roughly 5. This is live, 4.75 right now. You can see what's going on. We have a very critical, this is very structural pattern symmetry. So I want you to focus on the structure as I do. And you're going to start to see things. You can see here clearly, if you want to draw it in a way, this is a symmetrical triangle, almost an equilateral triangle right there. And that intersects at the bottom arm of the triangle is around 2776, which is the 200-day moving average. And this red line here, that is the support that I put through, and that is approximately around 2786, 2800, 2801. Well, we hit 2800. I said we'd hit 2800 based on the charts and as we started to melt today, because this was Friday, by the way. So if I wanted to show you where we closed that Friday, well, you should be able to see it on your screens too. It would be this beautiful reversal hammer crossing over the 50-day moving average, kissing the 34-day moving average. Technically, it couldn't have been picture perfect. So this was Friday. There we go. Now we can see it. Okay. What we do here at Clueless Trading, for a lot of new people who are listening to this, many new members, as well as other people from the outside who come and listen, visit us at the Google YouTube channel, listen, that we focus in on the mechanics and the dynamics of the internals of the market, whether it be the external candlesticks, whether it be the internal, such as the full stochastic, Mcclellan oscillators, and MACDs. We look at sometimes we look at the Arun oscillators, sometimes we look at the ADX line, but for now we're sticking to the full stochastics and the Mcclellan oscillators. We are looking into the guts of the market and looking to find directional bets, and that's where the big money is made. And we have repeatedly proven that despite the most difficult, excruciating, frustrating, untradable circumstances on certain days, we have hit close to the bottom. We have bought around there, and we have made significant profits. Just Friday alone was an example of that. So here was Friday. We hit that level. We had a massive, we hit around 2,800, slightly above 2,800, 2,825, I believe. Let me see here. Yeah, 2,825, as I'd repeatedly posted on my real-time Twitter feed. And then we had this monster candle. I mean, you can't get any more bullish than this, okay? The only thing that was missing was we didn't get a very sharp move higher on the full stochastics, but it was still on the 10th, which was Friday, starting to climb up, just the way it did here. And with a huge rally, multi-week rally that started in March, just the way it happened here back in the first week of March. That was the end of March into early April. We started to see that turn. And then today, this happened. So this was a beautiful reversal candle, big, long tail. I mean, it's like I haven't seen a long tail reversal like that in a while. But lo and behold, today was the after effects of the Chinese retaliation, and the technicals flipped real fast. So it caught a lot of people by surprise, especially large funds and stuff, hedge funds who were and mechanical machines, which went with this bullish flow of money. That candle didn't appear because I sat there and painted it with a crayon. That appeared because billions and billions of dollars went into the stock market on Friday after the vicious opening down and then the reversal higher, prompted by some very favorable tweets that came out of President Trump, right? So, and if you completely missed out Friday, why don't you scroll through and you can catch up on everything. It's right there on my real-time feed. So saying all that, we ended the day, we kissed the 34-day moving average and we ended slightly lower, but it was just a very bullish candle. So today was that flip down, and that flip down caused a massive institutional force margin selling across the board. All sectors, all 10 sectors were down. And on the S&P 500, I think a few utilities were up. A couple of stocks identified that I looked at on my scans that were green. And aside from that, pretty much it was a full red day. 90% downside day. So this is what happened. Okay, so it doesn't matter what happened on Friday. Technicals can flip. I want you guys to appreciate that, just the way it happened here. This was on the 21st of March, very bullish candle. Then on the 22nd, flip down. What happened on the 22nd? Flip down. What happened on the 23rd? There was a lower low right there. Hit 2788. See that? And then within a matter of 1, 2, 3, 4, 5 days, well, starting the next day, the market started to move higher. Will that be a repeat of this? Don't know, but it certainly can. No question about it. The other thing is that despite this intense dropping in the market, we are still seeing the 34 and the 50 moving average. These are still uptrending. The 20-day moving average has started to buckle a little bit. It's starting to bend, obviously, because we have had 1, 2, 3, 4, 5 days of intense selling, today being the worst, and the market closed towards the low. Well, bumped up a little bit from the lows, but still. So we have had pretty much 1, 2, 3, 4, 5 days. So obviously the 20-day moving average is starting to ease back a little bit. Aside from that, the 50 and the 34 are still trending higher, and that's a good sign. What the market initially will do, which is where some of the biggest money is made, is the market recovers this entire 617 point down that we closed today. We were down almost 750, right? Big. It at least tries to kiss the back end of the broken 50-day moving average. Now we are looking at futures here. So I'm showing you the futures. The futures 50-day moving average is 2864. We closed at 2807. So that's roughly 60 handles, roughly about 420 to 500 points can be had within the next 24 to 48 hours. Okay? At least test. Even if the downtrend remains intact, it will at least try to test the 50-day moving average. Now, if we look at it on the SPX, the 50-day moving average was lost. This has happened almost 100% of the time. Okay, just so you know. It at least tries to test the 50-day moving average and then fails again, in which case the market will go lower. So let's take a look at this. Let's go daily. The 50-day moving average on the S&P 500 is still, it's pretty amazing that despite this is the funny part about when you look at technicals, kind of eases your mind a bit. Despite the dropping that one can take on days like today, these are the days, like I said, you set up trades. Just the way on Friday, I said everything that was sold by the retail emotional freaked out trader was bought by tactical traders at or close to near the day's lows. And then what happened by 4 p.m.? Monster rally. Made some huge profits. So the funny thing is that when you look at this, it's still a bull flag. It's wild. I mean, you got these massive moves down, the world's falling apart. No one's gonna have dim sum anymore. I mean, just kidding. I mean, seriously, it just feels like that, right? So here's the lows, the Christmas Eve massacre, June 12/24, and it was 12/26, day after Christmas. All these are corrections, small ones. Each candle is a day. That was 1, 2, 3, 4, 5 days, 4 days, and the fifth day the market turned. This lasted about 2 days. So here we are, that if you still look at this, we lost the 50-day moving average, yet it still looks like a bull flag. So again, being a non-emotional tactical trader requires a lot of discipline. How you train your mind to do it is simply by focusing on charts, and looking at all the internals, looking at things, and not making a rocket science type of situation out of it where your mind just gets bored and says, just screw it, I'm not going to even deal with that, but just looking at it in a very simplistic, direct manner. You know, being a non-emotional trader is really easy to say, but practicing it, it's extremely difficult. So I really appreciate it when a lot of people try and they still fail, they still get too emotional and not buy at these, you know, close to these major tactical bottoms, tradable bottoms on the market. I don't blame them, but what I do blame them for is for not trying. At least give it a shot. You might be surprised how mechanical your mind is, and as the bombs fly over you, you know, like as in the market uh, type of, you know, news bombs and things like that, it makes you much stronger technical trader. And I think these are the times to really focus on that. You know, just a piece, you know, just a good suggestion. So this is still looking like a consolidation channel. So looking at this here, the 50-day moving average still trending higher. Pretty amazing. Look at that. This was the crossover where the 34 crossed over the 50. That was back on right before Valentine's on February 11. And since then, the 34 and the 50 are still climbing higher. Now, I've always said, and I will say it again, and this is when you start to get really kind of short-term super bearish, is when the 34 and the 50 cross under. That's when you start to say, oh, you know, things are either getting really bad or there's just, you know, the market will have a very difficult time. But we are far from that, so we'll keep an eye on it. When you get this crossover, you want to stay long, right? 34.50 crossover. So when you get this 34 and the 50 cross under, which doesn't happen unless the market falls more, but if it does happen, you can rest assured that is some pretty serious technical. That's a technical signal saying that the market will suffer at least a month or two of a larger decline. So we are not, you know, we're not even close to that on the daily charts. You can see that right there. But if you want to premeditate that, certainly go short, buy puts. You know, it's up to you. But I'm just showing you what we see here. So it could very well happen. But at this point, the retest of the 2862 right there on the 50-day moving average is a high probability trade. So as a trader, you want to capitalize on that. It hit the 2800 mark, 2801, well, 2800.32, and just kissing the back end of the 34-day moving average. Might fail there, might not. Might, as it's done before, it might cross over the 50-day moving average and you know, try to get towards the 2900 level. But first things first, 2862 right there is your point of contact that we are trading for right now, which is a very decent trade from this level. Okay, so that's, you know, just to keep it simple, that's pretty much it. That's what the market is trying to do. Here's your 200-day moving average, which is extremely critical, 2775. I showed it in my other charts that there's a possibility that we hit those levels. This is the 150-day moving average at 2742. These are extreme scenarios. Can they happen? Sure. Of course it can. Okay. We have two other fact risks in the market which are which are not being talked about as much. One, we have sent some heavy-duty aircraft carriers, Patriot missile battery launchers, and stuff like that to the Persian Gulf. There's a storm brewing out in the Strait of Hormuz, where the world's 70% of the world's oil supplies pass through, because Iran supposedly has hit secretively damaged some Saudi oil tankers or something. Okay, and that was news after the market too today. So that's something to really be serious about, because if there's a flare-up of tensions, and Iran's not the kind of country that's going to sit back and do nothing, they're going to strike back if we attack them. I don't think they're going to attack us first. They better not. But there is a trio. Saudi Arabia is anti-Iran. Israel is anti-Iran. We are anti-Iran, politically speaking. This is all political stuff. And so Iran feels, like they're all ganging up on me, and does something stupid. If the firefight breaks out, oil's going to spike big time. Markets are not going to like it. It's going to be a short-term thing. I don't think there's going to be a full-fledged war, but what the heck do I know? Many times we've come close to getting into a firefight with Iran, and we haven't, which I think is a good thing. If Iran needs to be confronted, Saudi Arabia and Israel needs to do that. Our boys don't need to go shed their blood in Iranian war. I mean, that's my opinion. Okay, get our proxies out there, the Saudis and the Israelis, to go do the dirty work. Okay, that's my opinion. So saying all that, we have moved some heavy-duty aircraft carriers and stuff. So that's a political risk that's looming. The other thing is this Brexit crap that's still going on in the UK. United Kingdom still can't get their head straightened, so we have to watch out for those two things. Can't think of anything else. Well, we know the China stuff. That's pretty much it. Okay, so let's take a quick look at excuse me. I guess all these fantastic amount of tweets that I put out there, keeping everyone posted, has given me a little bit of a dry throat. But I'm not even screaming. I'm just kidding. That was a complicated joke, guys. Okay, so 15-minute charts, again, to repeat, very useful if somebody's doing some quick day trades and such. This is where we are right now. We hit that 2,800 level, and this is what we are doing. Okay, futures are up about 750, but they have, they have a lot of resistances along the way, right? But in life, you look at the glass, either is it half full or is it half empty? So if you look at it from a half full standpoint, then you can say, hey, I have a pretty nice room to move here towards this big blue dotted line, thick blue dotted line, which is the 50-day, I'm not 50-day, 50 Fibonacci retracement, right? Which is 2881. That's pretty decent. 2800 to 2881. That's 80 handles. 80 times 7, 560. 80 times 10. It's anywhere from like 600 to 650 points. All right, right there. Remember, this was Friday, and this is the greatest representation of what can happen. You make big money trading these tactical levels, setting up some nice trades. Look at that. That was Friday. Look at that rally. I mean, that was one heck of a rally. We pinpoint, I mean, we notified our members, and a lot of them did tremendously well. There. Okay. Then this happened today. So that was Friday. So is it possible that we get a reversal rally up towards the 50? I think it's a high probability trade. So don't just stay tuned, act on it. Even if you get a good portion of it, you should be fine. Okay, there we go. So that's your short-term intraday type of chart you can rely on to set up the trades. Same thing with this. This is your 15-minute chart. 15-minute charts, mind you, can be really frustrating because every 15 minutes the market's flipping around, like I said, in between each of these levels, like a monkey on a hot tin roof. And sometimes it's like a monkey on crack, like I said, right on a hot tin roof. So it's like crazy looking at these candles, like moving up nicely, and then bang, it comes down. But they all happen off certain resistances and supports. So that's what you have to keep in mind. So there's an old saying in the business, and I always used to say that to my clients. I think I was the one who coined it, that there is a method to the madness. Focus on the method, not on the madness. And I know it's easy to say, but I try to follow it as much as possible. Focus on the method, not on the madness. You focus on the madness of the markets, which is basically volatility, you're going to go mad. And that is exactly what unfortunately happens to retail traders. So please start, focus on the method, and the method is basically tactical trading. It's a fact. You can run away from it. So this is where we are. This was Friday. Look at that. I mean, it was just a massive monster short squeeze. And then this was the drawdown, the gap down. Markets tried to recover a bit. This was all after hours. I mean, pre-market. Then the market opened up at around at 9:30. So let's look at 9:30. 9:30 here. This is where the market's open. Bear with me. That's where the market's open. Came down, started to go higher, slipping and sliding. And as you can see, it is creating a W. Where does the first level of the W hit? At 28.36. Next level of the W formation, known as the Dragon Bullish, is 28.44. Now, each of the levels that it hits, for some of the newer traders who are trading off these charts, it's going to find resistance. That means it's going to zigzag around. So each of the levels where it hit, it tried to find support and bounce. So each of the level that it's going to get hit, it's going to try to pull back a little bit because sellers will come in. But net, it will zigzag its way higher, barring any other major unforeseen type of black swan type of news and tweets and such. And I really hope we don't get another overnight tweet from President Trump. I mean, seriously, we don't want like, oh, they got so badly beaten, and now they just gave us a little bit of tariff. They're too scared to really put out more tariffs. They can't put out more tariffs. They don't, we don't even sell that much into China. We do, obviously, but not as much as they're selling to us, for a simple reason. We are the biggest, most voracious consumers in the world. We want to buy everything cheap. That's the reason why all our big super centers, Walmart, Costco, all those guys, BJ's Wholesale Club, all selling the stuff, and a lot of them are made in China. It's just the way it works. Keep prices down, people buy these goods, and everyone's happy. So, obviously. So China's, we are the biggest shopping mall in the world. Can't change that. We stop shopping. We don't have a problem with China in that case. They won't sell to us because there's no one to buy. But we are the biggest shopping mall in the world. So, so obviously our appetite for consumer goods is just endless. So this is the major neckline, 29.70. That would be pattern completion. Will that happen in a straight line? Hey, it can happen. It happened on Friday. Most probably not. Most probably it's going to zigzag its way higher. That's what we're going for. It's a very decent sum of money. Keep your head straight. Keep on looking at the charts and do what you need to do. And I'll keep on doing my best. There's your gap fill. This is the first gap fill. This is the second gap fill. We closed on Friday afternoon around here. Okay. This is the same 15-minute chart in a different format with the Fibonacci retracement. This, we already covered it. This is your 1 hour S&P chart, not live, obviously, because S&Ps don't trade live. E-minis do. So this is not an E-mini chart. This is the actual S&P 1 hour chart. We filled two major gaps here. I don't see any other gaps down here other than one here, which was kind of filled 28.74. We possibly slipped. There is one here. So if things go completely wrong, we are going to collapse all the way down here, not in a straight line, but I'm just telling you, just showing you guys, and guys, we should be able to see this yourself, that this is another gap here that hasn't been filled, and that was from the 11th of March. This is your longer term chart on the weekly. This is actual futures, and you can see that it hits some major support levels, which were previously resistance. One was the breakdown level from December 3rd, 2018. October 15, 2018, these acted as major resistances before the market took off. Now we came back and retraced and we touched and we are retesting those breakout levels. So from a real technical standpoint, keeping all the noise aside, there's nothing unusual in what's going on. What we are doing is we are testing this big level that we broke out of after weeks and weeks of trying. After 3 weeks of trying, we had broken out of this massive resistance level, which were the previous supply zones. You can look at my old videos. You can scroll down my Twitter feed and find these dates, but you can go and look at my videos and you can see how many times we attempted and what I said that these would get broken out, would break out, and it did. And they broke out on March 18th and March 25th. So what we're doing is we're retracing back here in two heavy red lumps, even though this was a big reversal on Friday. This is the new week starting, but in two red candles, big ones, hundreds of points, we basically are now retesting that where we broke out from. So there's really nothing majorly wrong with it. What I would like to see is the full stochastic start to turn from here, because if the full stochastic, and this is a word of warning, is going to retrace all the way down here and get as deep of extreme oversold as it was back on Christmas Eve or in the month of December 2018, then that means we have further to fall. That further to fall is something we have to watch out for. That means that we will come back and retest the 2700 level down here, right there, 2720, which was the past critical support that the market tested almost 2 times, 3 times, and twice almost back in March. So without getting too technical, that is still a possibility. We shall see. This I'm monitoring. This is a weekly. That means it doesn't happen in one day, but there's a possibility, but that by the end of the week, who knows? I mean, this is monthly options expiration. Generally, it's a bullish expiration week. We shall see. But this could retest down here. All right, guys, this is your S&P 500, not the live version. This is actually, futures are up about 9 right now. This is where we closed at. Like I said, technically it's a pretty solid finish. Lower gap, upper gap. In between, there's these Fibonacci levels. If you're a SPY trader, highly suggest that these are the times in the market you really need to grind your teeth, need to sharpen your knives. You basically learn and train how to trade technicals. These are perfect technical markets in an imperfect volatility. So try to understand what I said. These are perfect technical markets because they move within certain levels and everything that I show on the charts. Yet it's an imperfect volatility, meaning the volatility just comes at you in waves, both on the buy and sell side. There you go. Very, very oversold and high probability reflex bounce. So that's basically it, ladies and gentlemen. I just want to give you the bigger overview. Now I know that Miss Trina here wanted to look at a chart of Roku. Roku is a trading stock, Trina. Okay, so when Roku was up a lot, you should have sold it. Maybe you did, because the minute you see a reversal candle, and this definitely created a reversal candle. We had the 90s, and then I said buy the 88s. Then you got to be, if you're a Roku trader, you got to keep an eye on the screen. All right. So I'm not saying you didn't. You probably sold it and took some nice profits. But if you notice right now, Roku has an inverted hammer. So where is the next level of entry? Somewhere in the 77, possibly retesting this sharply rising 5 SMA at 75. So 75 to 77 would be the next entry on Roku. Intraday, these hedge funds love trading Roku. I mean, it's like, they're just their machines just love trading Roku. So today was Monday. So here was Roku, markets collapsing, and Roku's just creating a massive bullish hammer, bullish candle. You're like, whoa, what's going on? Nothing's going on. It's just technical moves. did that, hit the 85 level, and then boom. This is why you have to watch the 15-minute charts on this baby and then look at the daily charts to start to figure out whether or not it's a reversal candle. I wouldn't short Roku because it's pretty heavily shorted. I'm sure it's not that heavily shorted anymore, but starting at, as the markets were recovering, believe it or not, 1045, Roku started selling off. Was there any news and stuff on it? I don't know. I didn't have time to check. So this is where the stock is right now. Okay. So in answer to your question, that's your Roku chart. This is your short-term chart. Trade it using the 15-minute, trade it using the 1 hour. Whichever the case, it's an identifiable double top on the stock right now. That means it is a little bit of rest time. I could be dead wrong. Tomorrow morning, Roku could turn around and create a massive bullish hammer and take out 86. But I'm just telling you what it's showing right now. See how symmetrical this chart is? It's all machines, algos running and day trading this particular stock. I would be more apt from a technical standpoint to be a buyer looking at the daily charts on Roku. You can see that inverted hammer, 77, 75. Break 75, the stock's going to hit this dotted line. These charts are drawn to perfection. When this was doing this, it looked likely it was heading towards 90. Some nice profits on it. Nice profits. There were 140% or so on those 90 calls from Friday. Took a bunch down, and the little bit that I'd left, you know, they came down pretty hard, but it didn't matter because the bulk of my profits was taken. That's why you have to be a very tactical trader in Roku, and the same thing with a lot of these stocks, whether it's Netflix, whether it's Apple, whether it's Amazon, whether it's Nvidia, whether it's Qualcomm. You know, another stock that went berserk, still had some, which I didn't get a chance to highlight today, was Match.com. Those calls, the 70 calls, were up 110%. The stock was went from 68. That's Match.com, one of our big winners from earnings, from 65 during the day to $70 almost. You wonder, like, why? Who cares why? That's what the markets do, you know. So individual stocks, it's a very stock selective market, and you have to follow the charts. Simple. What can look really good can switch down. So if you don't like those type of stocks, then buy the United Healthcare type of things, which are solid charts. And even in the worst markets, they are barely down, if not up. So there you are. Any other stocks I can show to anyone? Mike Murphy, any particular stock? No?
No, I'm fine.
Okay, that sounds good. So just want to cover that. Don't want to drag this on. We covered quite a few things, showed you all different aspects of it. So net, the key thing to keep in mind, as I said earlier on, that technically we have had, I'm kind of conflicted in what I'm, what I'm looking at, in the sense that in a way it's, I know it sounds crazy saying that this doesn't look that bad at all. This just looks like a nice, powerful, with lots of green candles. 1, 2, 3. This was a neutral candle. 4. So there were 4. Let's do a day count. Let's do that back in the days. A day count. So let's do a day count. We have how many red? 1 big thud down, right, from 295. The spies. So 1, 2, 3, 4. We have had 4 red candles. 4 red candles. We have 1, 2, 3, 4 with a very powerful reversal hammer, green candles. Yet it just feels like the world's falling apart. It's pretty incredible, right? So I repeat again, we have 1, 2, 3, 4 red candles in these past couple of days since the market pulled back from the highs, and we have had 1, 2, 3, 4. in general, if you look at the green candles, I think you guys would agree with me on this. They look pretty healthy on each of these days. These look pretty unhealthy, but these look healthier than the red candles. I'll leave it at that. But there is still room to move a little bit lower. But like I said, if you stay technical and try to train your mind to look at the market in the ways I'm explaining to you, you might find it helpful. You might find it very conducive to making profits even in the most difficult circumstances. On that note, have a great evening. God bless you all. See you guys tomorrow.
Good night.